Have you ever paid for insurance for years, never used it, and still felt like you somehow lost money? Like, really think about that for a second. Month after month, the money leaves your account. You don't crash your car. You don't end up in the hospital. Your house doesn't burn down. Nothing happens. Which is exactly what you were hoping for. And yet, at some point, maybe late at night, maybe when you're checking your bank balance, you catch yourself thinking, wait, where did all that money actually go? That feeling right there? That quiet confusion mixed with relief and a little bit of frustration? That's the entire insurance business model in one emotion. My name is Noble, and I spend way too much time thinking about how money really works behind the scenes, especially in systems we're told to trust but rarely understand. And if you're someone who pays for car insurance, health insurance, life insurance, maybe even multiple types at once, and you've never really sat down to understand how these companies keep making more and more money even when nothing goes wrong in your life, make sure you hit that subscribe button. And give this video a thumbs up if this helps you out, because today we're going to unpack something that most people never think about, but once you see it, you can't unsee it. We're talking about how insurance companies make money even when nothing happens. Now look, I want to be very clear from the start. This isn't an insurance is evil video. Insurance exists for a reason. It can save lives, protect families, and prevent financial ruin. But here's the thing most people never realize. Insurance companies don't make their money the way you think they do. And the gap between what you think you're paying for and what they're actually selling you? That gap is where billions of dollars live. Most people assume insurance companies make money when bad things happen.
Un car accident.
A surgery. A house fire. That feels logical, right? You imagine them cashing in on disaster. But that assumption is completely backwards. If insurance companies only made money when something went wrong, they would be bankrupt in a year. Their ideal world, their dream scenario, is one where you pay them faithfully every single month and never, ever need them. Here's what most people don't realize. Insurance companies are not built to win on individual outcomes. They are built to win on averages. They don't care about your specific story. They care about millions of stories blended together into predictable math. Let me walk you through this slowly, because once you see the math, the psychology starts to click in a really uncomfortable way. Let's say you pay $150 a month for car insurance. For some people it's less, for some people it's more, but let's stick with $150. That's $1,800 a year. If you drive for 20 years, which is very normal, that's $36,000.
$36,000.
Now ask yourself honestly, how many people do you know who got $36,000 back from their car insurance company over their lifetime? Not many. Some people get a payout or two. Some get a decent one after a big accident. But most people? Most people never come close to getting back what they paid in. And that's not an accident. That's the design. Now zoom out. According to industry data, auto insurance companies in the US alone collect over $300 billion a year in premiums. In a good year, meaning fewer accidents than expected, they pay out less than they collect. That difference is called underwriting profit. And most people think, okay, that's where the money is. But here's where it gets really interesting. Underwriting profit is only part of the story. In many years, insurance companies don't even make much profit from underwriting at all. Sometimes they break even. Sometimes they even lose a little. And yet, the biggest insurance companies on earth keep getting richer and richer. So how? They invest your money. This is the part almost no one talks about. When you pay your insurance premium, that money doesn't just sit in a vault waiting for you to crash your car or get sick. It gets pooled together into something called the float. And the float can be enormous. We're talking tens or hundreds of billions of dollars sitting there for months or years before it's ever needed. And during that time, insurance companies invest it. Stocks, bonds, real estate, infrastructure, private deals, everything. Warren Buffett, one of the richest investors of all time, has said that insurance float is one of the greatest financial inventions ever created. His company, Berkshire Hathaway, uses insurance float to invest on a massive scale. And here's the wild part, even if they eventually have to pay claims, they still made money in the meantime by putting your premiums to work. So even in a year where nothing happens in your life, where you never file a claim, your money is still out there making money. Just not for you. Now you might be thinking, okay, but that makes sense. That's just smart business. And you're right. But understanding this changes how you should think about insurance entirely. Insurance companies are not hoping you get into an accident. They are hoping you don't. Their favorite customer is not the one who needs help. It's the one who quietly pays and disappears. That's why they love boring people. Safe drivers. Healthy people. People who don't ask questions. People who don't file claims. People who forget they even have insurance because nothing ever goes wrong. Those people are gold. That's also why you get discounts for being claim-free. Think about how strange that is. You're being rewarded not for using the product, but for not using it. Imagine if your gym charged you monthly and then gave you a discount for never showing up. That would sound ridiculous. But in insurance, it's normal. Because you are not the customer they build the business around. You are the data point. And this is where psychology comes in, because if insurance was sold purely on math, most people would hate it. If an insurance company sat you down and said, hey, over the next 30 years, you're probably going to pay us way more than you'll ever get back, you wouldn't sign up. So they don't sell math. They sell emotion. They sell peace of mind. They sell the ability to sleep at night without thinking about worst-case scenarios. And humans are incredibly bad at evaluating risk emotionally. We are wired to fear sudden catastrophic loss far more than slow, predictable loss. Paying $150 a month doesn't feel painful. Losing $50,000 in one moment feels terrifying. So we gladly accept the small, steady drain to avoid the big imagined disaster. This is called loss aversion. Psychologists have shown that people feel the pain of losing money about twice as strongly as the pleasure of gaining the same amount. Insurance companies understand this deeply. That's why their advertisements don't talk about probabilities. They talk about stories. What if this happened? What would you do then? Protect your family. They sell you the feeling of being responsible. And here's the part that's hard to admit. Even when insurance is financially inefficient for most people, it still feels like a win because it reduces anxiety. You can lose money and still feel successful if your fear goes down. I once spoke to someone who paid for health insurance for 12 straight years. No major illness.
No surgeries.
No hospital stays. Over that time, they paid close to $48,000 in premiums. What did they get back? A few routine checkups. Some minor reimbursements. Maybe $1,200 total. Financially, that's a terrible deal. Emotionally, they were completely satisfied. They said, well, at least I was covered. And that sentence right there explains everything. Insurance doesn't have to pay you to feel valuable. It just has to make you feel safe. Now let's talk about claims for a moment, because this is another area where people misunderstand how the system works. Insurance companies don't usually deny claims outright unless there's a reason. Instead, they design the process to be just annoying enough that people hesitate. Long forms. Confusing language. Phone calls. Waiting periods. Follow-ups. Documentation. And most people are busy, stressed, or emotionally drained when they're filing a claim. That friction alone reduces how many claims get completed. Even people who are entitled to payouts sometimes decide it's not worth the hassle. And every claim that doesn't get filed, or gets delayed, or gets reduced, that's money the company keeps. Again, this isn't about good or evil. It's about incentives. Insurance companies are optimized for predictability. They don't fear accidents. They fear surprises. That's why they use massive data models. That's why your premium changes based on your zip code, your age, your driving history, even your credit score in some places. They are constantly refining the math to make sure the averages work in their favor. They don't need everyone to lose. They just need most people to quietly overpay a little. So what do you do with this information? Because the goal here isn't to scare you or make you cancel all your insurance tomorrow. The goal is to help you think clearly. First, understand what insurance is actually good for. Insurance is most powerful when it covers rare, catastrophic events. Things that would completely destroy you financially if they happened. Major medical emergencies. Total loss of property. Liability that could bankrupt you. Insurance is not great for small, predictable expenses. That's why high-deductible plans often make more sense financially. You're using insurance as a backstop, not a first line of defense. Second, build your own safety net. An emergency fund changes how you interact with insurance completely. When you have savings, you're not relying on insurance for every little thing. You're using it intentionally. Third, actually read your policy. I know that sounds boring, but most people have no idea what their insurance does and doesn't cover. Confusion benefits the company, not you. And finally, stop thinking of insurance as an investment. It's not supposed to make you rich. It's a cost, a tool, a trade-off. The mistake is paying for emotional comfort without understanding the financial consequences. Here's the big reframe I want you to walk away with. Insurance companies don't make money because bad things happen. They make money because most bad things don't happen. They win in normal life. In boring years. In quiet months. And once you understand that, you stop feeling confused about where your money went. You start making choices instead of assumptions. Because the real danger isn't paying for insurance. The real danger is paying without awareness. If this helped you see insurance differently, hit the like button, subscribe for more breakdowns like this, and remember this: the moment you understand how money actually flows, you stop being scared of systems and start using them. I'll see you in the next one.